Hey, JJ here with the Art of Value. Wow, what a session again. I keep saying that every day, don't I? Don't I? The day before last was a huge rise, and last night we have the market headline, CNBC, of course, special report. Markets in turmoil tonight, 8 p.m. So we've reached the stage of markets in turmoil headlines. And what happened was, you can see there, if that was on video, by the way, if you're on video on YouTube or Spotify, you'll be able to see that, otherwise on audio. So I'm going to explain a bit more for those on audio. So the S&P was down 3.56, the Dow 3.12, and the NASDAQ 4.99%, which is a big move, nearly 5% in one session. So that's prompted the markets in turmoil headline. So what's interesting to me also is that in the past 24 hours from when I'm recording this, Bitcoin is down 8.24%. So it's kind of acting like Bitcoin's still acting like a NASDAQ stock, a tech stock, an emerging tech stock, rather than a currency or even, it's acting like a unstable, volatile, let's say, volatile. So this is the heat map. We're looking at the heat map for last session, and it's red, red, red. There's a few green spots there, but say Apple down 5.57%, Google down 4.75%, Amazon down 7.56%. So these had big up moves the day before, but big down moves. Tesla down nearly 9%. Well, not nearly, over 8%, and Microsoft doing kind of the best at minus 4.36%, when that's kind of the best performance of the mega caps. Something has gone south. And what's happened, just to take a bigger picture, I'm looking at the NASDAQ graph for 5 years, and it's back to 4th of December, around early December 2020. So that's after COVID. It's not back to pre-COVID levels at all. But the Nasdaq is in a bear market, but what I like to think about is that, well, Jeremy Grantham, who was the most bearish in saying that it's a giant bubble, it's deflating. It's been deflating, starting with the emerging tech stocks, like innovation stocks, back in February 2021, early February 2021. And he's, he's saying they were the first to be shot, and then now the generals are being shot, more than a year later. And so we're not back to pre-COVID levels. And he sort of said that he thinks that the major indexes like the S&P could go back, wound back 50% or more back to where the bubble started, which he thinks was kind of around mid 2020. So in that case, there'd be a while to go, but I don't know. I'm not predicting that. He's predicting that, and that's kind of the most bearish kind of prediction out there. But what happened was, we can speculate about why this got wound back, but we could say that the traders in particular had to think about it, or the market thinks, if there's a general market thought that after the rate hike being relieved that it wasn't more than 0.5%, kind of had to rethink about it. Excuse me. And what caught my eye just this morning, morning my time, is that this Bloomberg video kind of summed it up for me. This guy who was talking about market dismissing prospect of soft landing. All right, so let's see what this says.
Coming back to the idea of where the economy goes from here, the concept of being able to navigate to a soft landing. What is the general tone in the markets right now on that narrative?
I think that at this stage, the market is dismissing the probability of a soft landing almost in wholesale terms. We're effectively saying we're going to over-tighten. The question is, when do we actually see a recession, and when does the Fed subsequently need to cut rates in a fine-tuning give back from however far they're able to normalize policy rates? Now, the debate, at least from when we think about it and make the rounds isn't whether or not this is a 2024 or 2025 story. It's is it later this year or the beginning of next? Because the Fed is very aggressively putting the brakes on the economy. We're seeing that in a wide variety of sectors, and we're starting to get concerned that we haven't seen any weakness in the labor market yet, but that will be the next proverbial shoe to drop.
Okay, so weakness.
Where the economy goes from here.
Let me turn that off. Weakness in the labor market is the next thing to drop, but basically saying that the market's kind of lost faith in the Fed that it'll be a soft landing, and that's going, sort of pricing in a recession now. It's just a question of how big that will be. Raising rates to the point where there is a recession, or that they won't be able to help that, and so the market is pretty pessimistic. Okay, so what we have next, I've got here, what I wanted to say was, the bear market's actually that the NASDAQ's in a bear market, and the S&P 500 isn't in a bear market, but it's been wound back to April 2021. It's more than a year, 13 months. So, but again, Jeremy Grantham's prediction of that being wound back a lot more. We'll see if that happens. But it's definitely, it's not 20% down. So, but the Russell 2000 it's been wound back to December 2020, and it's in a bear market with the NASDAQ. And so I just picked up this tweet here from this popular trader who's had huge gains in the last few years during that bull market, trading in high growth stocks, high growth tech stocks. Peru Saxoner is his name. You might know of him. He said the selling has been brutal. This was just this tweet recently. The selling has been brutal. So many stocks either near their COVID crash lows or around their pre-COVID January highs. All QE gains gone. So the QE gains from the Fed quantitative easing, printing money, and government stimulus as well. All those are gone. It's been wound back for the high tech stocks. So the S&P 500 doesn't show that, but there's a lot of carnage underneath these high growth stocks that got into a bubble, I think, and it's been wound back. So also typified by ARK, of course. I talked about this before. ARK Innovation ETF took a big hit last night, and it's back to August 2018. So that's being wound back as much as I've seen, back to 2018. And of course, there's this short positions on this. I think Peru actually shorts this as a hedge. He has high tech stocks, high growth tech stocks, but he actually uses shorts ARK as a hedge. It's and kind of that sort of strategy because it typifies a lot of these high growth innovation stocks that aren't profitable for the most part. But what's another interesting thing about ARK that I wanted to say today was that I saw this tweet. ARK has had the largest one-day inflow in a year. So basically, people are still buying the dip. So there's money going in. They've had their largest inflow over during the last session. I think was after that big up day before, but a lot. If you can see the graph on the screen, if you're on video, still people are sticking with it, still buying the dip. So does that mean that the carnage will continue and until people stop buying the dip? I don't know, but it's quite a thing to see that ARK's still having these huge inflow days. And so we have, carrying on with ARK, this tweet by Christopher Bloomstrand, who is a kind of an expert on Berkshire Hathaway, and it's one of his main stocks, I think. Don't think he's done incredibly well over the last few years, being a sort of value investor, investing in what might be termed value stocks. I don't know, but I think Berkshire's one of his main positions, and he has been very critical of ARK in the last few months. And he was criticizing Cathie Wood tweeted about, and I think Elon had a word about this too. It was sort of a big conversation on Twitter about passive funds. Cathie said passive funds prevented many investors from enjoying a 400-fold appreciation in Tesla from 1.6 billion market cap at its IPO in June 2010 to around 650 billion when it entered the S&P 500 10 years later in December 2020. And Chris Bloomstrand quoted that tweet and said, "Remarkable. While passive funds were prevented from enjoying owning Tesla until it entered the S&P 500, ARK was able to do so. Yet, despite owning Tesla, ARK has underperformed the index since its 2014 inception. That's total return, not massive dollars lost. Go figure." So he's criticizing ARK there, and Kathy in particular, for underperforming, even though she says that even though Tesla's one of their main stocks, they hit, to put it into perspective again, looking in ticker here, ticker terminal, ARK ETF, if you look at all time, so going right back to inception, even now, today, it's had 149% return over 7.5 years, and that's 13% CAGR, compound annual growth rate. So 13% is not actually that bad, even though it's kind of getting into underperforming territory. 13% a year. I mean, a lot of people, say on bear markets in particular, would be pretty happy with that, especially if the bear market continues, but we don't know how low ARK will go, and people are certainly putting money in. But 13%, it's not Warren Buffett's near 20% or just under 20%, I think, for 57 years or something like that. But, that's not so far, not too bad, but there still could be more pain to come. We don't know. And the thing that's worthy of criticism is that of her coming out and saying that she's expecting a 50% CAGR over the next 5 years. I don't know how that's even legal for a fund manager to come out and say that. But anyway, so that's all I've got for you today. What a day in the markets. What a day. Markets in turmoil. So, will it continue? Is the US heading for a recession? And other parts of the world, obviously, too, probably, if the US does go into recession. We'll see what happens. So if you found this valuable and interesting, like and subscribe, and see the video on YouTube or Spotify video and audio everywhere else. Catch me on Twitter at The Art of Value. Thanks.